Thanks, Nikki. It's always a pleasure to be back at APORDE. And I'm going to try to do something that I always is pretty difficult, which is to try to make the subject of taxation seem relevant and interesting, and really, and I think it's a topic that often was dominated by mainstream economists, accountants, lawyers, and it was a very dry and dull subject. You know, everyone knows the expression, death and taxes. And so I'm going to try to give you a perspective that makes you think about the role that taxation plays in development differently, its developmental role, but also how taxation tells us as much or more about governance and power structures than almost any other indicator when you start to think about it, and also world geopolitics. So I'm going to share the screen right now. So just getting back to, I mean, one of the things that I think is quite important is that there was a lot of discussions of good governance and how countries are going to achieve this, with very little discussion of the material basis of the state to actually fund these things. Because providing good quality social services and political order and these things and subsidies to promote structural transformation, which you've learned all about, takes a fair amount of resources. And so there was discussions of things like accountability and transparency and so on, without an understanding that a very low income country collects between $50 to $200 per person in tax. And I think one of the numbers, and I'll show this in a slide later, but one of the kind of things that I would like you to take away from this is that we need to think about growth in the context of a very low tax base where the state has very little money to provide goods and services and infrastructure to promote that growth. So, a typical or median sub-Saharan African low-income country will collect between $200 and $500 per capita. Some of them are at the higher end. South Africa is an outlier in that regard, so is Namibia. But for most of the other countries, and some of the oil countries like Angola would be an outlier, but for most of the other countries, we're talking about hundreds of dollars per capita, and that needs to be contrasted with the fact that an OECD country collects something in the order of $20,000 to $40,000 per capita each year. Right? That's per person. So we'll see tax ratios, but I want you to remember that the denominator, tax over GDP, right? That denominator is much bigger in a rich country, and so the ratios can be very deceiving. The actual amounts that are collected are very different. And so I think the first big point I'd like to impress on you is that one of the main reasons why you can't transplant best practice from OECD countries, even if we're thinking about structural transformation today, is because their tax base is on the order of 100 to 1,000 times more per person. And the types of governance and the types of growth strategies that will matter in that context are very different from what's peddled. And that's not often thought very clearly when there's discussions of governance or even industrial policy for that matter. Where are the resources going to come from? And one of the things that I think this lecture joins up with a lot of the other lectures is that because resources are so scarce, and that's the operative word, selectivity inherently has to be part of industrial strategies from a fiscal point of view. And so when we think, and one of the second big idea I'd like you to think about is that we're going to try to think of tax not just about how countries collect it and how much they collect, but how taxation policy links into production strategies. That is, how and why does tax become developmental? And we'll see that there's not a big difference in the tax collection across countries, less developed countries, but there's a very big difference in the developmental impact of those taxes. And we'll go into that. Now, to give you a flavor of the fact that tax doesn't have to be a boring subject, there's lots of famous quotes about it. One of the ones I like is the political philosopher Edmund Burke, who argued that revenue is the chief preoccupation of the state. Nay more, it is the state. If you have a state that collects peanuts and wins an election and collects $50 per person, what is that elected leader going to do for most of its people, right? And that's very different from a state that collects $30,000 per person. The fiscal system in a rich country is the heart of what political contestation and competition is all about, because there's a lot to play for. I mean, just to give you an example, the United States collects something on the order of $7.5 to $8 trillion a year, not billion, trillion. Right? And so that's about 1/3 of the US GDP. Now, $7 or $8 trillion, just to put this in comparison, the UNDP SDG, Millennium Development Goal budget. Does anyone have any idea what that was? You can put that in the chat. For the whole world, the Millennium Development Budget. Think of the U.S. number of 7 trillion for one country in tax collection. Well, if someone puts it in, great. If not, I'll just give you. I'll tell you without any suspense. It was $50 billion, right? That's for the whole world. So 50 billion versus 7 trillion for one country. And so just to give you an idea of the order of magnitude of what we're talking about. Joseph Schumpeter, he's known as the father of fiscal sociology, as well as coming up and writing a lot about innovation and the dynamism of the capitalist system and his idea of creative destruction. He argued that the fiscal history of a people is above all an essential part of its general history. And Charles Tilly, who was a sociologist and historian, just wrote about how in medieval Europe, states were created, tax states were created, not because of some fancy theory about you need to collect taxes to finance public goods. No, states began in medieval Europe out of the necessity of war. Monarchs had to raise armies to defend themselves against frequent invasions, and they had to collect tax from elites, mostly landlords and merchants at the time, to be able to pay for armies, because the alternative was that they would have been invaded and everyone's assets would have and life would have been wiped out. And so, Tilly's has a book called State, Capital, and Coercion, which is on the reading list. And I think that book is quite important because it highlights the fact that state capacities are not just technical phenomenons, right? There's often the role of threat, war, and violence has played a very big role in the construction of tax states and of developmental states through history. And it's important to understand that there's a very political aspect to the consolidation and construction of states, what today is often called state building. Now, why is taxation important? I mean, this is something that's relatively straightforward. For one, taxes is important to ensure sustainable funding for social programs and for public investments to promote economic growth and development. A lot of sub-Saharan African countries recently, and a lot of countries around the less developed world, have become more interested in collecting tax because it gives them policy space. So the first, why tax is important. Obviously, a standard explanation is to ensure sustainable funding for social programs, public investments, public goods to promote economic growth and development. But it also increases policy space. The more a country can collect in tax, the less it's dependent upon the wishes of donors. And a lot of even low-income countries in South Asia, sub-Saharan Africa have taken a greater interest in this aspect because policy space is quite important to giving countries the room to maneuver and implement the policies they think are best for the country. It's a key element of state building and state capacity in several ways. One of the main reasons why it's a key element is that it's the main nexus that binds state officials with interest groups and citizens. So not only is tax important for building resources to fund a state, but it also provides a focal point for interest groups to lobby for changes in taxes, to lobby for different types of taxes, to lobby around how the fiscal resources are used, how expenditure from those taxes are used. And so, tax, because it mobilizes groups, it's constitutive of as much of state capacity as it is of civil society. And that's, state taxation creates this mutual obligation between state and citizen, between government and citizen, between government and interest group. And because of that, I think it's probably, the amount of tax, how it's collected, tells you so much about the legitimacy of a government, because most tax is collected passively, right? People do it through quasi-voluntary compliance. They're not forced by barrel of a gun to pay their taxes in most countries. Where you see that happening, that's a sign that a government is not legitimate. And so taxation itself, when it's voluntarily paid, tells us a lot about the legitimacy of government. Even if you don't agree with the ruling coalition in power, the fact that people agree to pay taxes means that a lot of people at least passively buy into the rules of the game of a polity or of a governing territory. And so, I think as an objective indicator, it's probably worth more than all of the subjective indicators of governance that are out there, like corruption, like transparency, accountability. These things are based on subjective surveys asking people, do you think the government's transparent? Do you think the government is corrupt? Taxation, matter of fact, it's one of the better statistics collected. The IMF's government the IMF data series on tax collection is actually one of the more reliable international data we have. So it's an objective indicator, and it's linked through various political theories about why it's such an important indicator of governance and state capacity. And it's often you'll see taxation amidst 40 other indicators in a governance kind of index. And I think it should be weighted much higher and put at the top of the list. A, because it's an objective indicator that you can measure. You don't have to ask people. And B, because the data is pretty good. And C, because it's linked to lots of political theories around why it's important. Thirdly, tax, particularly in the form of land and property tax, customs and border collection, can demarcate territorial reach of the state and help secure property rights. We'll come to that, but early on, historically, the ability of the state to collect land and property tax gave it a territorial reach, but more importantly, it gave it a way to have this mutual relation with this interaction with elites that created institutionalized bargaining over government policy. And so it's a way for the state to embed itself. It can be predatory, it can be confiscatory, but it often lays the basis of more nonviolent institutional negotiation between interest groups and the government, which is at the heart of good governance. Coming back to the second point about state building and state capacity, I think it's important to highlight the fact that a lot of revolutions and episodes of dramatic change involved tax revolts. The Boston Tea Party was a revolt against the system of taxation that the British put on the American government, and that was the clarion call of the American Revolution. And so, the phrase "no taxation without representation," that became, in a way, the mantra of the liberal view of taxation, that there's this mutual obligation. But behind that line, no taxation without representation, is this idea that, tax resistance and tax revolts tell us a lot about how a state is formed and when it was formed and why it was formed and what identities develop around it. And, the United States, one of the hallmarks of its sort of governance is that it's a quite low tax state for an advanced industrial country, partially because the nation was born on a resistance to taxation. Yes, in this case, colonial taxation, but nevertheless, there was a resistance to taxation that still is part of the American political DNA, ideological DNA. There's an aversion to very high tax and welfare states, as you see in Northern Europe, and we'll come back to this issue. And finally, state legitimacy depends not just on winning elections, but to a large degree on fiscal capacity. Right? And Michael Mann, who wrote a classic book called The Sources of Power, argued that democracy becomes sustainable in countries when you first have a consolidated central government that's able to collect resources regardless of who's in power. And so for all these reasons, taxation plays a prominent role in the political economy of government, of governance, of growth, and of democracy. Now, some of the themes I'd like to go through very briefly are, there are many approaches to tax. And by the way, at the halfway through the lecture notes, I'm not going to get through them all. I've left you substantial amounts of complementary notes. And I've also, on the reading list, you'll see other references as well. So if you want to go into certain topics that I won't have time to go into, you can look at those. I hope they're pretty self-explanatory. But if they're not, you can always get in touch with me. Nikki has my email, and all the information that you need to get in touch with me has been provided. So we're going to go over the mainstream approach to tax, which is the neoclassical and administrative approach, which provides the kind of dominant sort of neoliberal thinking about tax. And then we're going to discuss about how we can think about tax strategies differently, and what a late developmental approach to taxation would look like. And then we'll briefly discuss some political economy considerations of how elite bargains and other political economy factors affect the prospects of tax collection. If we have some time, some additional topics that I've provided, which we may not have time to go into, are around the role of urban property taxes, which I think is a quite important one in contemporary debates. The issues of illicit flows and offshore tax havens, it's a very big topic, especially since the world financial crisis and COVID. And finally, a section on mining revenue and mining tax regimes in sub-Saharan Africa and the debates around that. Okay, so the first approach to tax, the one you may be the most familiar with, is the kind of neoclassical approach to optimal taxation. And this traditional analysis, I'm not going to go into the technical details, has focused on the design of tax systems that makes possible financing the necessary level of public spending in the most efficient and equitable way. And so in the traditional analysis of tax, there's this trade-off between efficiency and equity. We need to collect taxes, possibly to make the world more equitable, that is, tax from the rich, give to the poor. But also, we don't want to tax so much that we create a disincentive for investment and profit making. And that's the traditional dilemma that's discussed. And so key questions in this key questions in this literature are things like, what is the necessary level of taxation? Who should be taxed? How should they be taxed? And so the neoclassical analysis has tended to focus on things like the consequences of income or wealth taxation for incentives and risk taking. So for example, very high taxation, corporate tax, is that a disincentive to growth and to investment? And we'll see that that's dominated the thinking in the last 30 years as corporate tax rates have come way down compared to the 1950s and 60s. The traditional approach is also interested in the effects of corporate taxes on investment and the distribution of profits. And also, and this is an important idea, and it's the most difficult one to measure, is how different households or groups are affected or burdened by tax changes, the so-called tax incidence. So for example, if a government raises corporation taxes by 10% or VAT, is that passed on to the consumer? If a corporation tax goes up 10%, but the price of all goods go up 10%, then it's consumers and not the corporation that's paying for the tax. Tax incidence is a very simple idea, and it's a very important idea. It's a powerful idea. It's a very difficult thing to measure well, given the data that's available, even in advanced industrial countries. I'm going to just go for this slide first. As we talk about tax, I just want to be clear about some of the language. this is just the tax can be broken down into types of tax and their incidence. So direct taxes refer to personal income tax, corporate income tax, and property and land taxes. Direct taxes have the greatest resonance in political theory because people get very upset about how money is spent if they have to fill out a tax form and pay directly to the tax authority. So a lot of the theories of political revolution and revolt and representation and accountability revolve around using direct taxes as the main proxy that motivates people to resist. Now, these taxes tend to be progressive. What does progressive means? It means that wealthier households pay a greater proportion of their income in tax than poorer households. And so property, land, and personal income tax tend to be quite progressive. Now, indirect taxes tend to refer to consumption taxes like sales and VAT, and trade taxes, import and export. Now, they tend to be regressive, and the simple reason is that consumption is a much bigger part of a household budget of a poor household than a rich one. Right? If you're worth billions of dollars, there's only so many things you can consume. And so if you have a flat sales or VAT tax, that's going to burden the poor much more. And there's ways of making VAT less regressive by zero rating basic goods, like basic foods and medicines and so on, and putting a slightly higher tax on luxury goods. That would make that type of tax slightly regressive. And then there are the sin taxes, excise taxes, like sin taxes like alcohol and tobacco. And these are, they tend to be progressive for luxury goods and regressive for things like tobacco, where the poor consume more of them. And often the goal is not to collect revenue so much as is to change public health behavior, right? By getting people to consume less of these things. And one of the reasons why these taxes are very effective is because the demand for people that are addicted is very inelastic, right? If the price, if you're addicted and the price of cigarettes goes up to $5 to $10 a pack, you'll continue to buy it in pretty much the same amount. And that's why governments use this tax, because it's a very lucrative form of collecting revenue. Now, when we think about these types of taxes, I'll come back to this slide in a minute about the two opposing views of growth. One thing I'd like you to notice is that, richer, higher income countries tend to collect more tax as a percentage, about 25 to 28%. Low income countries collect a little more, between 10 and 15%. But remember, this is, so there's lower tax collection, the lower the level of income per capita. And that's principally, we'll come to this, because levels of informality and subsistence are much higher in lower income countries. So there's, it's harder to collect tax. But what I'd like you to recall from this is that one of the things that I think is quite important is that these ratios are very deceiving, right? The United States collects about, most of these countries, by the way, collect, some collect up to 45 to 50%. Right? These high income countries include a lot of upper middle income or poor high income countries like Southern Europe and so on and so forth. There are some countries that collect up to 45 to 50% of GDP. But these ratios, remember, can be deceiving because the denominator is very high, right? So the absolute amount per capita is not clearly picked up in these type of ratios. But what you will see is that richer countries tend to collect a lot more direct taxes than poorer ones, direct taxes and land taxes, which are a much smaller, although growing part of tax collection. Consumption taxes tend to be a much bigger part of the tax base of low-income countries, right, compared to the other ones, which means that the possibility of a tax system in a low-income country redistributing income is very low, because the green part, the consumption taxes, they tend to be at best neutral and usually regressive. The burden is mostly on the poor. And so one reason I wanted to bring this chart up early is because the tax system, one of the things about a tax system at low income levels is important to remember from a political economy perspective is that it's very difficult for the system to be progressive because consumption taxes, income taxes are too low, consumption taxes are too high, and there's just not enough tax that's collected per capita to be progressive. Okay. Now, coming back to the neoclassical view, like everything in neoclassical economics, there's opposing models. One of the things that you often see in a lot of discourses around tax, but government policies generally in development, is that neoclassical economics does not mean neoliberal policies. Neoclassical economics was used to design the Soviet central planning system by Oscar Lange in the 1930s, 20s and 30s. Neoclassical economics can produce laissez-faire models like those of Milton Friedman. It's a methodology. It's not an ideology. It is a methodology that prioritizes a methodological individualism and the individual as a unit of analysis. But the models that are generated from this method have very different policy implications. And I think that's important to recognize. And within neoclassical, there's broadly two lines. There's a hardline neoliberal view, which is that, argues that taxes provide disincentives to investment and growth. And, this is the supply side economics that you want as limited a government as possible because governments tend to generate, state intervention generates lots of rent seeking and corruption, and very high taxation is a disincentive to investment. In a nutshell, that's what neoliberal economic policy is about. The private sector's more effective manager, and the taxation system, when it's very high, is a disincentive to investment, and it directs resources from the private to public sector, which in this view is less efficient than the private sector. And so that's the kind of general view of, and by the way, this is a developmental view of taxation, right? It's the argument that minimal government tax is the best growth strategy. Now, we can disagree with it, and we'll see that there's no evidence to support it, but that's one neoclassical view. The other one is the more moderate or heterodox line, which recognizes that taxes are necessary to finance public goods, health, education, and infrastructure, and that particularly infrastructure, that the tax collected can crowd in as opposed to crowd out investment and generate even higher growth than without the tax that's collected. And this is because welfare states are not just social security nets, they're also part of the production process, because a more educated and healthier workforce is going to be a more productive one, and more productive and effective, efficient infrastructure will crowd in private sector investment. So this view is the kind of generally opposing view, and this is the view that would be compatible with most of the developmental state literature that you've heard about in the course of APORDE in previous lectures and in subsequent ones that you will hear about. So these are the two views. The neoliberal view of neoclassical economics has tended to predominate. Since 1980, corporate tax rates have been slashed around the world. And this is looking at the OECD, the non-OECD is in red, and then tax havens offshore. So you can see particularly tax havens have really dropped their corporate tax rates to well below 20%. And this view, this is probably one of the best slides to illustrate the dominance of the neoliberal or supply side view. And so the neoliberal approach to taxation is all about keeping taxes as low as possible, since they distort resource allocation. Neoliberal economic policies, they will argue that taxes, especially income taxes, provide a disincentive to growth. You want to promote FDI with investor-friendly tax regimes, like giving firms 10 to 15-year tax holidays. There's a lot of export processing zones use this strategy. Accompanying this as part of the package are things like privatizing SOEs, liberalizing financial markets and capital accounts, and a general policy focus to shift away from income and corporate tax towards consumption taxes. And liberalizing trade, that is lowering import taxes and eliminating export taxes as much as possible. We'll see this last one is quite important because um, low-income countries, one of the easiest types of tax to collect, this was true in sub-Saharan Africa, and this is in the core readings that were sent, is that import-export taxes for weak states tend to be the easiest type of tax to collect. And so trade liberalization can actually take away the dominant source of income very quickly from a government. People often think of trade liberalization just in terms of IMF and World Bank structural adjustment logic, but they don't think of the fiscal logic that if you take trade taxes away because of liberalization, you need to replace them with other types of taxes, and those other types of taxes are often very difficult to implement, and it's often very slow. And sub-Saharan Africa took a long time to substitute the lost trade taxes from structural adjustment programs in the 1990s. Now, this supply side view views the state, a small state, as the best pro-growth strategy. But one of the difficulties facing low-income countries, as I just mentioned, is how to replace these declining trade taxes in the face of liberalization. And several of the core readings go through this problem that sub-Saharan Africa faced for quite a long time and still does in many ways, which we'll see. Now, what's the evidence? The evidence is that there's no evidence it's inconclusive for the supply side neoliberal view of a small state and low taxation. And this has been known for quite a long time. A quite famous econometric piece by Easterly and Rebello in 1993, which is in the bibliography of some of the core readings, pointed this out. And it's unsurprising that it's difficult to establish it's difficult to disentangle tax regimes from other macroeconomic phenomena such as monetary policy or micro ones such as industrial policy that affect growth paths. So, for example, if you lower taxes, but you can't secure property rights in a country, or you have rampant corruption in a country that's unpredictable and so on, you're not going to get growth. And so you could raise taxes and actually have an improvement in the security of property rights, and you could have growth, but it's hard to know whether that's because you raise taxes and are providing public goods or because you have more secure property rights. And so it's difficult to disentangle these things. And by the way, that's a very important thing when people do research on, what is the effect of Chinese aid in, Ethiopia. It's very difficult to know that because there's a lot of things that affect growth in Ethiopia. And so whenever you come across single issue topics, always remember there's an interaction effect that's very difficult to disentangle. And so one of the reasons why there's no evidence is that econometrically it's difficult to promote. But another reason is theoretical. And this is a chart from Nicolas Crafts. This is in my wider paper, the 2006 core reading. What does this show? This table is looking at countries with big welfare states. So what this is looking at is government revenues and government expenditures in the 80s and 90s. This table, by the way, would be very similar if you did it in 2010 to 20. What do you see on the left-hand side? You see that there's a varieties of capitalism out there. The famous book by Soskis and Peter Hall called Varieties of Capitalism. There's lots of different varieties of capitalism. There's not one tax regime or one size of welfare state that can generate growth. If you look at, If you look at these countries here, these are big welfare states. Countries at the bottom tend to have smaller welfare states. So the first question becomes, is countries that collect a lot of tax and spend a lot on welfare states, do they have more or less effective economic performance? This is looking at GDP per worker hour, per hour worked in 73 and 96. This is from a chart from Nicolas Crafts. And what this points out is that in 73, yes, the US was very productive, but so was the Netherlands, which is a high income place. But if you looked at 96, the US had gone down a bit. Countries with very high tax collection and welfare states were very productive. They had higher productivity in the United States. If you look at productivity per worker today, this chart, what you're going to see is it's very close across rich countries with very different fiscal systems. So obviously you have to ask the question, what is Sweden and the Netherlands doing, and Denmark and countries with, and Germany with big welfare states, that's not negatively affecting their performance? That is the supply side story. In the United States, people think Sweden is a socialist country, it's a communist country. But that's because the political ideology of the United States is it's a very right-wing country politically. It doesn't really have a center-left dominant political party for all kinds of historical reasons, but of which racism is one of the central reasons. But this chart is very important because this is telling you that, well, it must be the case that, yes, you can have more private sector social provision, as in, say, the US and Japan, or you can have big welfare states. What do welfare states do? Well, they do things like provide huge budgets for worker retraining. So workers are often less resistant in Denmark and Sweden and Finland to job redundancies because they know the government's going to give them a huge amount of money to retrain to be a computer programmer. And so welfare states, maternity leave, let's, publicly funded nurseries, allow women to remain in the workforce in the Nordic countries, in Netherlands, much higher than in other countries. That affects economic performance. The point is that the welfare state is not just a drag on economic performance. It has a very important role to play in production. Right? It's part of the production process because it provides public goods. It reduces the resistance to structural change because it provides lucrative worker retraining. And yes, you have to have incentives for people to look for a job to be able to access the state. But the reality is high tax, high spend countries can be just as productive as low tax, low spend ones. It depends on the time period. And the big point is there's a lot of varieties of capitalism that work. I'm going to go through this slide very quickly, but it just points out that if you look at regions around the world, the tax take and the growth rate, there's a big difference in growth rates on the right, but the tax take over GDP is quite similar. Of course, there's a lot of variation within these regions, and this was a historical chart. I put it up because it was in one of the readings that you had. The same story would happen if you looked at this chart of the tax today. Fact is, there's varieties of capitalism, and tax take itself doesn't tell you whether there's a disincentive or an incentive for growth. Before we move on to the next issues, I just want to point out some of the structural aspects about why we need to take tax seriously. Whether one believes in the supply side view or the more heterodox public finance view or developmental view of tax. And I think the evidence suggests there's arguments for both, but you're going to get probably a lot more dynamism and a lot more equality with a Nordic style type of capitalism than you will with a low tax system. But before moving on to the next topics, I want to impress upon you why it's so important to think about the fact that lower tax revenues simply means that there's much less of a percentage of spending that's possible because of lower tax collection. And so when we think of taxation, we also need to think of it developmentally in the sense that think of all of the public goods that cannot be provided in sub-Saharan Africa and the poorer parts of Asia because tax collection is so much lower, right? And lower here being sorry about that. I'm not sure. I'm not going to bore you with that. And so these yellow dots. So yeah, on the right here, this is the tax collection. This allows for much less public spending as a percentage of GDP. This is health, education, social protection. And again, remember, the sub-Saharan Africa, Ethiopia is about $800 per capita, and it collects about 15% of GDP. That's 15% of $800. The United States is about here. It's a little higher, 35%. That's 35% of $19 trillion. And so this is another point. When you look at statistics and ratios, one of the single most important things to remember is you need to look at the absolute value of what that ratio means. So Ethiopia collects about 15% of $800, which is $160 per person in tax. The United States collects 35% of it's actually $21 trillion in GDP. Right? So that's $7 trillion. Very important thing. One of the major things that's lost in regressions, and a lot of them are nonsense because they're atheoretical in the sense that when you don't look at the absolute amount and you just look at the percentage, you're taking away all the notion of late development, what underdevelopment means. And one of the single biggest hallmarks of underdevelopment is a low tax base, a tax base that we're talking about, dozens or hundreds of dollars per person in tax collection, and the thing and the things that affects for government. And so this is just, this is just for you to look at emerging markets, advanced countries, low-income countries, about what the distribution is. There's a lot of countries that collect around the middle. There's a few outlier ones. These are the Nordic countries, and the very poor, fragile states are here on the left. Now, in the further notes at the end, there's a set of notes on the kind of story about, there was a lot of literature on how Africa was improving its tax collection. And the reality is it has improved its tax collection over GDP in the last 20 to 30 years a little bit. But because the price of oil in that period went up a lot, the actual total taxes per capita collected, and this is in 2010 dollars, went from 884 in 1980 down to 345. So even though there's been an increase in tax collection, because of the oil booms, that tax purchases a lot less infrastructure than it used to. As a matter of fact, 1/3. And so, as a percentage of GDP at the top, again, ratios can be very misleading if you're not thinking about the purchasing power of tax revenues. Sub-Saharan Africa at the top in the highlight was collected on average 17.5% of GDP, went up to 22.3 and has stayed at about that amount through 2019. Okay? But actually, the purchasing power of this taxation is still quite low. So, and we're going to come to some other issues about why this is not such a Africa rising story. It's actually not such a rosy picture. And one of the reasons is that income taxes are still very low, and most of the taxes have been driven by VAT, which have replaced declining trade taxes. And VAT tends to be at best neutral, but it actually is a slightly bigger burden on the poor. But at best, it's neutral. And there are various reasons for this, but often involve political economy factors like the unwillingness or inability to alienate elites by taxing them. That's what Douglas North would call the elite bargain, or a tolerance for tax evasion, which is related to the elite bargain. And so one of the things, for example, why you see very little advocacy from sub-Saharan African leaders to do something about tax havens is that a lot of ruling coalitions benefit from them because they're a way to manage elite bargains. And we'll come to this idea later on for the sake of maintaining political stability. And so, the tax havens and illicit flows are a window into elite bargains. One thing that's important to remember, ruling coalitions always need to use patronage to buy off opposition. Max Weber talked a lot about patrimonialism and clientelism, and I think Mushtaq Khan discussed that with you, I'm sure, very eloquently in this series. And so you need to create huge amounts of side payments to very powerful elites to prevent political instability and potential civil wars. And a lot of the tolerance for tax evasion or the unwillingness to put on high levels of property tax or income tax, that's how we see the elite bargain working itself out in the tax system. And that's not a technical problem of the fact that these countries don't have the capacity and the computers and the technique to collect the tax. It's just that politically, it's very difficult. I mean, one of the biggest, most obvious things, if you want to think about power, is to think about the fact that if someone has take Northeast Brazil, there are huge plantations in sugar, coffee, tobacco, and so on, oranges. Some farmers have haciendas that are 1 million hectares. Now, you can't send a huge hacienda, huge plantation, you can't send that to the Cayman Islands or to London or to New York. It's right in front of your face, and you can see it go to the horizon. And the amount of property tax that's collected from that is virtually nil. And that's a story across most of the less and middle income and low income world. And by the way, it's a story that's also part of most of the upper income world as well. But they've replaced those property taxes, which used to be very important in places like Europe and the United States a long time ago, and Japan, but have been replaced by very high levels of personal income tax. Low income countries, right? I mean, property tax is negligible. You can't hide it, and it's still not taxed. I don't think there's a better example to show you why power matters more than technical capacity to collect tax. Also, the unwillingness to tax professionals, very powerful and influential people in the middle class, are a very big part of the tax gap and tax deficit in countries. And these mostly are internal political economy factors. This is not about blaming, external factors. Greece, I remember seeing a statistic. When Greece ran into trouble 10 years ago, it had a tax gap of about 10 percentage points of GDP, most of which had to do with the fact that it never collected any tax from doctors, lawyers, and accountants. If it had collected as much as even Italy does, and Italy has a lot of leakage, they wouldn't have been taken out nearly the amount of government debt that they had to, which caused really a Great Depression, partially as a result of Germany and the IMF's fault, but also partially due to the internal political settlement that created a huge tax gap and a huge fiscal vulnerability for that economy. So political economy factors are often behind the reason why tax is not collected. And to put that table in perspective, and I say this again, is that we need to, when we think of tax, and I mentioned this several times, I've mentioned ratio several times, because I think when we talk about issues of governance, of industrial policy, whatever you want to talk about, you need to remember that most sub-Saharan African countries collect $300 a person. And there's a lot of demands, right? We have a world that's connected by the internet, and there's a lot of people that have a lot of aspirations in the world, but all of the internet connection is not going to change the fact that a poor country collects something like $150 to $400 per person in tax. And that creates enormous expectations and problems of, the internet creates expectations of what a good life looks like more than ever. And the tax base creates what can actually be delivered in terms of public services. And that mismatch between what people expect and what governments collect is probably the single biggest source of populist politics and a lot of unrest in the world. It's not just inequality, it's the fact that many more people are becoming aware of and connected to, and on a daily basis feel what a better life looks like and feels like. But the tax base is a structural feature, right? And so structuralism matters. That's, the low tax base, I would argue it's a structural feature of trying to comprehend political economy in a low income country. And if you think you're going to import a model from a country that collects $40,000 per person, right, you might want to think again. Right? And so the implications of this, and I leave this slide for a little bit, for how societies are governed and how production is organized, is completely ignored by most discussions of tax, neoliberal, heterodox, Marxist, and otherwise. Right? It's something that needs to be much more mainstream in all flavors and ideologies of discussion. So what are the structural reasons? And this is coming back to the mainstream, the Tim Besley and Person article on the core readings goes through this. what are the reasons why developing countries have a lower tax take? One is that there's a larger share of particularly subsistence agriculture. There's a larger informal sector, which by definition is out of the tax purview. There are many small establishments with not modern accounting standards. There's a smaller share of wages and national income, and there's a much smaller share of consumer spending in large modern establishments. That creates a problem of tax handles. And so most of the mainstream literature, and this is true of the kind of the Besley and Person type of argument, and a lot of work the IMF has done over the years is to point this out, that a lot of poor countries have what are called weak tax handles that make it inevitably hard to collect tax. Now, I think, and if you read my 2006 wider paper, this misses the wide variation in the types and level of taxes that are collected at similar levels of development. So the East Asian countries collect more direct taxes than anyone else. And if you look at that 2006 reading, that's a little bit of a window into the kind of relationship the state has to elite groups. And that varies across the world, and that's missed. The other thing that's missed by the tax handle argument is that there are other ways of mobilizing resources, which we'll go into, that matter a lot. For example, forced savings, the inflation tax, marketing boards, and so on, which have played a very big sort of non-tax role, and we'll get to those. And so some other aspects beyond the kind of structural features are things like you have and these are important for governance to think about. The lower the income level, the more narrow the base of taxpayers, and hence there's been an emphasis on these LTOs, or large taxpayer offices and tax authorities. In a low-income country, something like 100 to 300 firms and individuals pay 85 to 90% of the taxes in absolute terms. That doesn't mean the tax burden doesn't affect everyone, but it's very few people that contribute the vast majority of the tax base. Just because one multinational paying a certain amount, BP operating in Mozambique, is going to pay more than 20 million people. And so just because those other people don't have that much money to be taxed in the first place. And so this creates, and this is a second big idea I'd like you to take away from this, this creates the problem of the demand for representation without most people paying a lot of tax. And I think this is a very difficult and underestimated governance problem. So in an upper income country, actually it's the middle class that pay most of the tax. The groups between, quintile 30 and quintile 80, the third and eighth quintile, pay most of the tax. And so in a low income country, the top 0.1% pay most of the tax. And so this very narrow base of taxpayers creates an important governance problem. Another one is a spatial problem of the dominance of the capital or main city in generating tax revenues. There's often not a spatial representation. So if tax is this milieu that links state and citizen, the fact that one part of the country creates most of the tax breaks this relationship across lots of other parts and can create negative problems for governance. Higher rates of tax evasion tend to be a big part of the political economy of low-income countries, partially because of the tax handles and partially because these narrow base of taxpayers tend to be more monolithic and more politically powerful. Fourth point is quite important one. It's a much higher level of non-tax revenues in the form of mineral and fuel rents, so oil, natural gas, and mineral rents, but also international aid. Now, this has spawned a huge literature on what's known as the resource curse. What is the resource curse? The resource curse is this idea. One part of the resource curse is this idea of the rentier state, and the rentier state refers to the fact that in oil export countries, a lot of the government revenues are quote unquote unearned. Unearned means that they come from a royalty with a multinational or a state oil company that's run well. That is, revenues come in that are not due to bargaining with large amounts of individuals and interest groups through society. And so the rentier state has argued that one of the reasons why you have a potential resource curse is that ruling coalitions can live and finance their activities without having to tax their populations because they get so much money from oil or aid. And this creates a growing autonomy from the ruling coalition and the citizenry. And this autonomy can create predation, violence, and all kinds of arbitrary rule because this non-tax revenue has broken the mutual obligations between the fact that people pay tax and they expect things from government. Well, if you're in a country like Angola, right, most of the government funding comes from oil, like 95% of it, and the 5% comes from taxation. Right? And so you have this mismatch where there's not effective bargaining over tax policy and over how money is used because most people aren't contributing to the tax coffers. And I think the rentier state has brought taxation back into mainstream discussions of why it's so important to think about not only if tax is collected, but how it's collected. Right? The type of government revenue you have matters a lot for the type of governance you're going to get. And so that's something to flag, and there's a huge literature on that. Other things that are relevant for fragile states, for example, are non-state rivals to tax collection. One of the papers that I wrote in 2010 in the further readings that I did for the crisis states program discusses this issue that, when you have warlords competing for tax collection, Afghanistan, Somalia, right? It's not so much that Tanzania collects a lot more tax than Afghanistan. It's just that the central government doesn't get a lot of it because there are warlords that collect it. And so if you have non-state rivals, that's probably the single, in fact, we argue that's the single biggest indicator of state fragility. Not whether you're a low-income country, right? Zambia and Tanzania and Malawi are low-income countries, but they don't have the type of governance problems, particularly violence problems, because they have a monopoly, at least over a basic Weberian quality of governance, which is tax collection. And the high revenues facing low-income African countries and how to replace trade taxes, I've already gone into, is a feature that needs to, when you think about transitions of policies, you need to think about what type of taxes are being taken away and can the government fill them in a reasonable amount of time with something else. This is just going to go very briefly. This is just another chart that shows richer countries collect more. We're going to move on to the two other big topics that I want to discuss, which is the second mainstream view, which is this administrative constraint, which is actually in many ways the most dominant one in terms of driving tax policy, especially as donors practice it. And then we're going to discuss an alternative way of thinking about tax, a kind of developmental perspective. Now, the administrative constraint, and the Mick Moore reading in the recommended readings after the further one talks a little bit about this, and so does my 2006 wider paper, summarizes this view. But in addition to structural features, one of the mantras of the administrative approach is that administrative capacity is tax policy. That is, you can't collect what your government is not capable of collecting, and this is very much part of this capacity approach. You shouldn't try to pull off anything complicated like industrial policy if you have a weak government. Now, here you have typical explanations of things like insufficient skilled staff, low public sector wages, lack of up-to-date equipment, complicated laws, poor enforcement of penalties, and poor information collection. And so the key problems in the mainstream approach to identify these structural features of the economy, informality and so on, and a lack of effective tax administration. And the mantra of tax administration is tax policy really is one of the things around one of the big policy solutions in the past 30 years, which is one is to simplify tax rates and laws, because they used to be lots of, much higher, lots of different rates, much higher rates on richer people to try to be progressive and so on. That's gone away. because it was deemed that most governments couldn't handle these, too many complicated tax rates. So simplification of tax laws, make revenue authorities autonomous from political pressure, similar to the idea of independent central banks, autonomous from politics, as if you can actually do that, and form tax policy based on the implementation capacity of the tax administration, and particularly give preference to VAT and indirect taxes rather than income and property taxes on the grounds they're easy to collect in both administrative and political terms. Now, this, of course, locks a government into, one, having a more regressive tax system, but two, by not taking on elites, it reduces the chance that the government, and often, by the way, the ruling coalition are the elites. So I'm not setting up a situation whereby the state is in some sense completely different from the elites. It's not, of course. But in political economy terms, what the donors have promoted is have made it quite simple for elites to avoid direct taxes by promoting VAT. In other words, they haven't really promoted policies that have kind of forced elites in their own countries to think about whether they might want to tax themselves more, not only for the sake of progressive taxation, but for the sake of more development in the long run, which we'll come to. So that's the kind of mainstream approach. Policy solution two is that in weak states, revenue collection authorities are more effective when they operate autonomously from the state, at arm's length from government, rather than within a government administration. So all of these semi-autonomous revenue authorities were created, and often they were created in parallel to the Ministry of Finance. And this fitted exactly with programs of new public management, making government more business-like, creating very high private sector wages in the state, and so on and so forth. And then Moore reading talks a lot about this. In the core of this new public management was the replacement of large, hierarchically coordinated public sector organizations with a more disaggregated or loosely coupled system. This is where decentralization comes in, also in terms of giving local governments more tax authority, and giving all these groups more operational authority and a contractual rather than purely hierarchical relationship to a superior funding and policy unit. And these SARAs were adopted, these semi-autonomous revenue authorities, by countries as a signaling effect often, even if they didn't believe in them, because a lot of aid donors and international donors saw this as a willingness to cooperate in their tax reform programs. So SARAs have been created all over the world in the last 20 years. Now, in the Mick Moore reading, in the further readings, which you can download from World Development, he argues that, and he runs, by the way, this very, very good tax center at Sussex called the ICTD, which I've put on its web link. There's lots of great articles on taxation, run the International Center for Tax and Development at Sussex. And Mick Moore was the director of that for a long time, and the founder of it. He argues that SARA officials tend not to think of tax collection and tax policy as part of overall production strategies. In a very kind of neoliberal, a critique of neoliberalism, he argues that senior tax officials are increasingly well-connected transnationally through personal and organizational linkages, increasingly able to migrate between domestic public posts with tax agencies, international public roles with the IMF, for example, or aid agencies as employees or consultants, and private sector posts, including jobs with the fast expanding Big Four accounting firms and international banks. And he argues that while the reforms have made it possible for governments to raise revenue from organizations, they've also increased the possibility that taxation systems will be shaped more by private sector interests, making it difficult for governments to raise the revenue that they claim they need. And I guess what he's arguing is that the kind of offshore tax accountants, offshore tax havens, a lot of these folks tend to rotate between working for tax authorities and working somehow for these international networks, and it makes for creating progressive or more developmental taxation quite difficult to implement. And so the influence of the mainstream administrative approach has been to simplify lower taxes, collect easier taxes such as VAT, create SARAs guided by the logic of new public management, and to restructure the SARAs by types of taxpayers. That is, like particularly look after particularly very wealthy individuals and corporations by creating large taxpayer offices and offer higher paying positions in computerized tax systems. All of these are as if the technical fix, first of all, it's buying into the supply side view of taxation, kind of neoliberal view, and also it buys in to the idea that taxation is mostly a technical problem. And the problem with when you think of the wider implications of the neoliberal approach to tax, which combines the neoliberal economics part and the mainstream administrative approach, is that one is the conception of capacity, and this is an important idea, I think, in this approach is static. There's no attempt to explain why administrative capacities differ across countries, or more importantly, how capacity changes. And so this is very much dovetails with the World Bank kind of good governance approach that, don't try difficult things at home. If you don't have a bureaucracy like South Korea or Singapore, don't try to collect complicated property or income tax, or try industrial policy for that matter. And I think that's been one of the most detrimental development paradigms in the last 30 to 40 years. And it doesn't ask the question, well, it's a kind of throwing in the towel approach. Well, should we give up trying to create property tax, or should you actually try to capacitate countries? Very recently, the IMF has started to realize that low-income countries need to take on more difficult taxes. And so you're starting to see a change finally happen. A second criticism is tax is not considered one of the 5 fundamental of good governance, which is quite astounding when you think about its history in state formation and so on. And this pro-revenue technical political approach to tax, there's very little of a pro-development approach. There's a divorce of tax policy from other developmental strategies. So there's a lot of thought about, well, the neoliberal tax view is a developmental strategy. The administrative approach, which dominates the work of the IMF and so on, really focuses on how much tax can you collect efficiently, not is the tax that you're collecting enough for it to be developmental. That is, tax is not linked to production strategies. And so the next sort of big topic, and the one I'd like to focus the most on in time that remains, is how to think differently about tax strategies. A late developmental perspective on tax prioritizes growth and structural transformation rather than medium to short-run distribution. Some slides at the end go into this. I won't. You can look at them, but the main reason we'll actually go through that right here. The main reason that fiscal policy can't really be thought of as a redistributive tool is because the per capita tax take is too low and income taxes are too small. And even if you collected more than is currently collected, they'd be too small to be able to have an effect of changing the income distribution in the country via the fiscal system. And there's a few slides at the end that I think are well worth looking at, just to give you an example. A country like Denmark or Sweden actually has a Gini coefficient that's quite similar to the United States before tax and spend policy. That is, its market income distribution before government is quite unequal. The fiscal system, that is the tax and spend in the Nordic countries, changes the Gini by 25 points, between 20 and 25 points. In less developed countries, the fiscal system changes the Gini by at most 5 points. In most countries, it changes at 0. And that's simply because the tax level is too low. And income tax is the tax take is too low, and income tax is too, as a percentage of tax collection, is too low. So that's one thing about a late developmental perspective. We need to think of tax and how it's going to create jobs, structural transformation, and exports, and movements from low productivity to higher productivity activities, which was the concern of Arthur Lewis. That's the first point. The second point is that resource mobilization depends on other things than taxation. And more important ones, and this is important to remember, is that State-owned enterprise profits matter a huge amount. Forced saving schemes, been a big part of the East Asian developmental state story, suppressing luxury consumption, suppressing foreign holidays, forcing people to put, say, some of their wages in postal accounts. So forced savings, it's not tax specifically, but it is a resource mobilization that has been as, if not more important than the tax take. So what separates East Asia from everyone else is the fact that it has high savings and investment rates, not its tax take. And that's often lost in the discussions of tax. And at the same time, most East Asian countries, as you've heard in APORDE, have not undertaken supply side policies in terms of industrial policy. They've been strategically interventionist, but they've been very interventionist in mobilizing non-tax forms of resource mobilization. Marketing boards have been another successful agricultural stories have had successful marketing boards, and marketing boards are a way of mobilizing resources for the state and using those profits and surpluses to build infrastructure and crowd in private agricultural investment. And finally, success in mobilizing resources can only be understood in a political economy framework and by analyzing the history of particular countries, including Charles Tilley's type arguments, the histories of war. So these are three big points. We'll get into some of the elements of this now. Now, what are some of these alternative tax policies? And this is just to give you a flavor of what linking tax to production strategies is all about. That's not going to be an exhaustive discussion, just an illustrative one. So these include things like the tariff. This is a historical perspective. Tariffs have come way down in recent years, but historically, tariffs were the cheapest way to promote industrialization. Why? It doesn't cost the government anything, and you protect infant industries. Alexander Hamilton coined the term infant industry in 1871. In his report on manufacturers, it was in 1891. And so, the tariff is much cheaper fiscally than a subsidy. A subsidy has to be taken out of the treasury to subsidize industry. Tariffs was the fiscally most sound way. And so in some ways, the current global environment of very low taxation has taken away the fiscally most sustainable way to promote industrialization, which was the tariff. Right? People don't think of tariffs as tax, but it's an import tax, right? And so because tariffs are much lower than they were in most of the 20th century, in the 19th century, reading Ha-Joon Chang's Kicking Away the Ladder, or earlier Frederick List wrote about that and coined the term as well, is that nowadays, development banks and development finance is going to be your biggest tool because the single biggest tool fiscally has been taken away. And so now somehow development finance needs to become a functional substitute unless countries start to become much more protectionist, which is hard to see. State-owned enterprise profits, right? Well-run SOEs are a huge source of government revenue. Poorly run ones, like the Zambian copper mines in the 1980s, is a recipe for not mobilizing resources. A well-run oil company is. More progressive mining taxation. I have some further slides on this, but sub-Saharan Africa in particular loses an enormous amount by terrible royalty deals, particularly outside of oil. The oil deals are not bad, but the deals in copper and gold and cobalt and minerals in general are terrible. And so, one of the single biggest ways sub-Saharan Africa could improve resource mobilization is to be able to tax mining more and use it to fund, beneficiation strategies or other types of industrial strategies. There needs to be an assessment of export processing zones because there's no evidence countries go because of tax holidays. And they're used across the board and create huge losses in revenues for governments. Urban and land property taxes are becoming back on the agenda. I hope I have time to discuss that at the end, because they're the single most important source of local government. If we take local industrial policy seriously, if you take municipal government seriously, most of that comes from land and property tax, and it's the most underutilized tax in the less developed world. It's also the most progressive tax, and it's also the least distortionary tax. So there's not even a supply side argument around not having property taxes, because unlike corporate taxes, land sits there idly, and there should be a tax on idle or underutilized land because it's a waste of resources. And again, the fact that it's so small tells you a lot about power structures in countries. The promotion of national savings, and I'm repeating a lot of these points again, just to highlight what an alternative perspective looks like. So, promoting policies that force savings in certain ways can be quite important. Export taxes and marketing boards are other ways on how we can think about linking tax to production. So I'm going to talk about one of the readings, which I highly recommend you reading. It's Deborah Browdigan's piece on the role of the export tax in sugar in the 19th and 20th centuries in Mauritius. Mauritius is probably, in terms of growth, the most successful story in Africa in terms of long-run growth in the last 75 years. It has an income per capita that's double of South Africa's, and for a very small island that's very far from markets, just in terms of geography, it has a very diversified economy for how small it is. And it has a lot of high value added production in the sectors that it does produce. It's more recently become an offshore center, but a lot of its economic development and diversification predates that. Now, why I want to highlight this as an illustrative piece is it's one of the nicest pieces on how one can think about analytically linking taxation to production. Right? It's not a pro-revenue approach. It's more of a pro-growth approach to tax. And the export tax was placed on sugar in the 19th and 20th century. And I'll leave some notes on the Colombian Coffee Federation, which is a similar story. It's probably one of the most effective marketing boards in the history of the developing world, in the brands that it's created, and the quality of coffee, and the export growth, and the distribution and branding of coffee. It's one of the most successful ones. And it's a story of how tax is both a social insurance and a production strategy. Now, before I go into the Mauritian example, I think it's important to remember that history provides several examples of, for example, the importance of land and property taxes in enhancing the territorial, social, and economic reach of the state. One of the things, when you see a state that's got a couple tax offices in the capital city, or post boxes for that matter, and then you don't see anything anywhere else in the territory, that tells you a lot about a country and its state capacity. Now, land taxes were a very important part of the tax base in the now advanced countries 100 to 200 years ago. That's a feature, one of the features of late development that's different for every country, including the successful ones, except, again, for the two outliers, South Korea and Taiwan, is that land taxes and property taxes are negligible. But they were upwards to 25 to 30% of the tax base in the United States in the 19th century. And that was true of Japan in the Meiji Restoration and in most of Western Europe in the 17th and 18th century. And why I highlight this is because it was a way of institutionalizing relationships between the bureaucracy and landed elites. And so there was a discourse that developed that where some cooperation became possible. It wasn't just an antagonistic relationship between the state and economic elites. And so when that discourse was created, a lot of policies became possible. The property tax in general is less than 1% across almost all less developed countries, and it's virtually non-existent in a lot of African countries. An important feature of these historical lands taxes was introduced as part of production strategies. They were earmarked taxes to help improve agricultural production. In some sense, marketing boards were meant to be the functional substitute of land taxes in Africa. But the link between tax collection strategies and production strategies is often lost in contemporary discussion of tax. And marketing boards got a bad name in sub-Saharan Africa because a lot of the money was siphoned off and not used and plowed back into agriculture. And as Arthur Lewis taught us a long time ago, and Michael Koletsky taught us a long time ago, if you do not develop productive agriculture, you will not sustain structural transformation, period. There's no exception to that rule outside of city-states like Singapore, and which is an exceptional case in history, actually, and Hong Kong. And so the role of marketing boards in countries that have had agricultural revolutions have been central to expanding the territorial interests of the state, but more importantly, linking rural elite interests and other interests, including subordinated groups, to the state. Now, in the case of Mauritius, export taxes on sugar, the main commodity in the 19th and most of the 20th century, had several positive effects on state-society relations and the productive capacity of the sugar sector, according to the Browdegum. First, this tax was an effective substitute for income taxes because it was mostly rich landowners that exported sugar. And so the export tax, it was harder to collect income taxes, but they collected it via the export tax. And this was generally progressive as it shifted the burden of taxation and redistributed spending on the wealthy and middle classes. Second, the tax was used by the state to finance research, development, infrastructure, and marketing, which enhanced the production and productivity of sugar growth in Mauritius. And that was its main export earner for 150 years, and it was one of the most productive sugar sectors in the world. Third, the export tax helped the private sector to organize. This is this idea that tax isn't about just collecting money for the state. It also helps civil society organize. Why? Because they can resist, promote, or they can resist taxation. They can lobby for a change in tax policy, but they have an institutionalized relationship. And to have that with the state, they need to mobilize and create business associations, which have other knock-on, other effects beyond just lobbying for tax policy. Right? They built their capacities to interact and formulate policies with government over time. We too often think about how things like resistance is a disaster or violence is a disaster, in terms of revolts over tax. If they allow people to organize and slowly institutionalize, those things shouldn't be viewed as failures. They're part of a process of governance. So as well, it helped both the state and the society to solve collective action problems they built in building skills, in building business associations, in supporting research on sugar, building research centers, and so on and so forth. And so there's a lot of discussion of let's build R&D and let's build, training centers. So if they're not linked to production and they're not linked to tax and they're not linked to institutionalizing a relationship of rewards and penalties with government, they don't ever work, right? And so one of the reasons why Mauritius is so successful is it institutionalized these relationships far beyond just the tax that was collected. And finally, the export tax helped develop the territorial reach of the state, something, for example, that a lot of fragile states don't have, since tax affected the main employer in the countryside and promoted mutually beneficial rights and obligations between states and farmers, both large and small. In the Colombian Coffee Federation, I urge everyone to read Rosemary Thorpe's piece. It's still a classic. It's still one of the best pieces on collective action you'll ever read. It's on the Colombian Coffee Federation in 2000. It's a wider paper. It's easy to download. And she talks about the Colombian Coffee Federation in a very similar way that Deborah Browdegum talks about what the export tax did for the Mauritian sugar sector. The National Coffee Federation provided evidence that the state uses taxation to solve collective action problems in production, such as the provision of funds for storage, distribution, marketing for thousands of dispersed smallholder producers, and help forge strong state-society negotiations and mutual obligations. So this is about, institution building and collective action for production, right? Not just for the sake of collecting tax and creating a relationship between state and citizen. It's about accountability and transparency for livelihoods, for productive capacity, for export potential. When you use the word accountability and transparency and don't link it with production and business organization, it often falls apart. And I think that's one of the big lessons that both this Rosemary Thorpe and Deborah Browdigan piece are very important to read. And there's a piece by Judith Tendler on the further readings called The Devil's Deal. And it's about a story of Northeast Brazil, the state of Ceará, which is one of the poorest states. It had a big leather sector. It was all informal, very poor, but very high-skilled leather makers. The state wanted to increase, widen the tax gap and legalize these firms, force them to register. And she argues that none of these policies ever worked in terms of taxing the informal sector or getting it to become formal until the state provided microcredit, distribution, and some production strategies to help these informal sector firms. When the state started to market these goods in Sao Paulo and Rio de Janeiro, all these firms willingly registered to pay tax because they could see the benefit. You cannot talk about tax. People are in there for a reason. It gives them a competitive advantage without linking tax policy to production strategies. And that piece is another very good example of how that worked out. Now, the final few things, I've talked a little bit about the elite bargain. Very briefly, and I'll send this as a further reading, Douglas North argued that a lot of states are held together by elite bargains, or what he calls limited access orders. And he argues that these limited access orders are created so that elites don't fight each other and solve a Hobbesian problem of civil war. And in the process of creating political order, elites share out huge amounts of economic rents and privileges amongst themselves. And this ruling coalition is a fluid sort of group. But what he argues is that there's purposeful limits to economic and political competition in countries through history, because you don't earn rents if there's competition. And so, there's this huge kind of politics of privilege is a big part of the political stability of countries. And North argues that every development practitioner should first always ask the question, why is this country not in civil war? And he argues civil wars are prevented, or political violence is prevented often through these elite bargains. And the 2010 paper that I wrote on the further readings, argues that exploring tax patterns can illuminate important insights into the shape and character of elite bargains. Why is there a tolerance for tax evasion? Why is there no property tax? Why are professionals taxed much less than other groups in other countries? I mean, these may be important for creating stability and state resilience, but we need to understand the fact that tax gaps are not issues of mistakes. They often have political origins. And also the nature of political bargains provide a window into the political limits of expanding tax capacity. I'm going to end here with the last two slides. The elite bargain in a country can tell us about why tax evasion is tolerated and what types of narratives countries need to have internally to actually collect taxes. And obviously, state officials and business leaders are often the same people. So this is a difficult conversation. But this conversation is related to why there's a negligible collection of urban and rural property taxes and relatively low rates of tax on large landholders, and the significant decline in the corporate tax burden of big businesses, particularly tax holidays. And also why almost every mining contract in sub-Saharan Africa in the last 30 years is a secret document. You can't find it. What are they hiding? Well, obviously managing the elite bargain behind the scenes. These are political economy things that we need to keep in mind when we talk about tax. And I'll finally, and so that last point I've made already, but I've also want to reiterate the point that I think because tax is a more objective measure of governance, you either collect it or you don't, and you don't need to ask executives of multinationals whether they think corruption is a problem. I think that should be more systematically used to incorporate as indicators into governance, resilience, fragility, more generally than it actually is, and certainly weighted much higher than it is in indices of governance like the Mo Ibrahim Index or the World Bank doing business studies and so on and so forth. So I'm going to stop here